This is a medical business. So you can see over the last 3 years, the total revenue has been steadily growing. Your total outlay is $36 million on those 3 businesses, and you're doing $9 million in EBITDA. You carry over to this range now. Your 9 times 7 is $56 million, your total valuation. Minus your 36, you've just made $20 million in additional value. What's going on, guys? Now, if you're wondering how much your business is worth, how much you can sell it for, or you're buying businesses or hoping to buy businesses as part of a roll-up or growth strategy, which is exactly what I'm doing, you've come to the right video. Now, in this video, we're going to be covering exactly how to value a business when you're buying or selling so that you know how much to offer when you are making these business acquisitions. Now, there are many different methodologies. No one of them is right. There's EBITDA multiples, there's net asset value. There is, you can do discounted cash flow modeling. You can do really complex modeling, price earnings ratios, all these weird and convoluted accounting kind of methodologies to value businesses. But at the end of the day, a business is worth what a willing buyer and seller are going to exchange it for, or what the business is going to exchange hands for between a willing buyer and a willing seller. So having said all that, we're going to go through a couple of the valuation methodologies, and then I am going to take you through a live model where we're going to value an actual business based on the EBITDA multiple, and I'll get into the reason why we use that over other valuation methodologies. Now, ultimately, the thing you must remember if you're buying a business is, it's a saying that I learned from my mentor. It's, does cash flow cover debt service? That means, can you pay off the debt repayments and other obligations of acquiring the business with the profits the business is generating? Ultimately, that's the golden goose. That's where we want to find businesses in that sort of valuation range. We want to find people that are willing to sell their businesses where the business will pay off its own debt obligations so that effectively you're not losing money every month servicing this business, rather you're making money every month. That's something for another video, and we'll get into that another day. But first, we do want to get a rough benchmark of what a market valuation for a business you're looking at might be. So, a couple of methods. The first one we're going to talk about is net asset value, NAV, net asset value. Now, what net asset value means is we add up all the assets of the business less the debt, and that gives us the value of the business. Now, the reality is most businesses that are asset heavy hold these assets and are very effective at utilizing these assets to generate a profit. And so we need to account that into our valuation somehow, and that's what we do with the EBITDA multiple. So this is the most simple and the most straightforward is, what are all the assets in the business worth, less their liabilities, and that's how much we're willing to pay for the business. It doesn't take into consideration operational efficiencies, and often businesses that are very owner dependent, where you're not inheriting those operational efficiencies when you're buying the business, get valued this way, right? The second methodology is the EBITDA multiple, okay? And that is effectively taking the profit times the multiple. Now, the multiple depends on a number of things, and I'm gonna show you how to find the multiple in just a moment. In very large businesses, and I suggest you go and watch the first video I made, very large businesses that are doing, $100 million a year, where there are legitimate corporate and institutional buyers coming in, private equity firms, massive companies that are interested in buying those businesses, those larger businesses will be worth far more than smaller businesses. Again, going back to the one-man show where we just look at the net asset value. But if it's a small business, let's say it is a e-commerce business that's doing $100,000 a year in profit, it's going to have a relatively low multiple for so many different reasons. One, there are more institutional buyers that are interested in buying those businesses, the larger businesses rather, and that's why the multiple goes up. The businesses run far more efficiently, right? They are much more stable. Okay, generally speaking, right? Of course, there are exceptions, but generally these larger businesses have a very hefty layer of management that makes the business far more stable without the owner being around, which means an institutional buyer can come in and buy this business, sit back for the most part, and let it continue operate. And there's a lot of value that is attributed to that. And that's why the multiple becomes higher. So those are some of the main reasons. Now, in terms of finding our multiple, basically what we want to do is a lot of research. You can ask ChatGPT, you can do some Googling, and you will get a multiple based on your country or geography, your industry, and your business size, right? They're the 3 main elements that we look at when considering what the multiple of a business might be. Now, in the example of a healthcare, we'll get into that in just a moment. So that's the crux of it. Now, what I like to do is I like to value at the greater of the EBITDA multiple or the net asset value, which means if there is a business where it's not generating much profit, and so the multiple comes in much lower than the assets of the business, that business owner, instead of selling the business, will break down the business into all of its little parts, all of the equipment, the machinery, the property, and sell them off individually, and he'll make more money that way. So it's not in his best interest to sell based on the valuation that comes out at the EBITDA multiple. He'd rather sell at net asset value. So what we do is we do a valuation of both net asset value and EBITDA multiple, and then we see which one is more, and we make an offer on that basis, provided that, like I said, cash flow covers debt service, that if you buy that business with debt or investor money or wherever the money comes from, that the profits of the business are going to be able to service those obligations. Again, that's a big discussion for another video as to how we calculate that. And that's when we want to do discounted cash flows and things so that we can see what the cash flows of the business are going to be in the future, see what our debt repayments and obligations are going to be, and make sure that those cash flows are significantly higher than the debt repayments and obligations, because when you do buy the business, it's also going to go through a bit of a rocky stage during the integration period, and as things are team members are transitioning, the old owner is transitioning out and whatnot, so we need to make sure we have a buffer. Again, conversation for another video, and we will get into that another day. Now, going back to this these valuation methodologies, we're going to go through an example in just a moment here. So EBITDA, what EBITDA stands for, we talked about it in the context of profit, but it stands for earnings before interest, tax, depreciation, and amortization. Okay, so that means when you're looking at a income statement from a company, looking at its audited or annual financial statements, the net profit number at the end, we want to add back any interest payments on debt that the business is servicing. We want to add back the tax that they paid. We want to add back the depreciation that they've written off on equipment and machinery, and amortization of loans and things like that. Now, the reason why we want to do that is because we want to get a true picture of how much cash this business is generating every year. And then we make our valuation on that basis, because tax and depreciation and even interest, all of these are subject to accounting. I want to say almost like trickery. If you have a good accountant, you'll know how this works. They're going to write down as much depreciation as possible so that you're paying less tax, and then the tax is going to be influenced by those depreciation write-downs. And all of these numbers are influenced based on the accounting methodologies that the company incorporates for perhaps tax planning reasons or whatever. And those don't necessarily impact the cash flows and the operational profit of the business. So we want to get to that operational profit, that EBITDA. That's what earnings before interest, tax, depreciation, and amortization is. And I'm going to show you in a moment exactly how to calculate that. So first and foremost, let's get into an example. Now, this is a medical business example that I wanted to show you. So this is a statement of profit and loss ending on X date. I've redacted a lot of the information and changed up a lot of the numbers so that it can't be traced back. But this is based on, it's not the exact numbers of or anywhere close, based on a real business that we've been looking at buying. Now, this is a medical business. So you can see over the last 3 years, the total revenue has been steadily growing. 2021 is when they started out, and they've been consistently growing since then, which is fantastic. We can see that they're growing by about 10% year over year, which is exactly what we want to see. And then we take away their cost of sales, which is effectively their stock, right? So if you go to a doctor's office or a surgeon, for example, they're going to have, perishable goods. They're going to need bandages and needles and vaccines and medicines that they administer, in the office and whatnot. So we subtract that cost of sales, and we end up with our gross profit. Pretty solid gross profit in this business. Now, other income, bad debts recovered, grants, insurance claims, little bits and pieces here and there. And then we have our operating expenses that brings us down to an operating profit of 1.966. Then we've got our finance costs, right? Like our interest. Ultimately, the profit for the year ended up between 3 million, 1.3 million, 1.7 million. It was floating, okay? So then what we want to do is apply adjustments so that we can get from a profit number to a EBITDA number. So here you can see we've got the exact same thing. The numbers have pulled through from the other side. Just excuse if they're a little bit different. Like I said, this is just an example, and I did have to change up the numbers quite a lot. And then we apply our adjustments. So other income, we add back. So we want to add back all of those EBITDA items. So the interest, tax, depreciation, amortization. We want to add back any non-recurring expenditure, as well as non-operational or non-business in nature expenditure, so that we can get an accurate picture of the exact cash flows that this business is generating. So you can see in this example, these line items have come straight from the profit and loss expenses. It's the things that we've identified, such as salary wife. The wife is being paid a salary for tax efficiencies, but doesn't actually work in the business. So her salary, we want to add back into the adjustments, and you can see that here. Okay. Same deal with all of these items. So other income is income from things that we don't know are going to continue into the future. So we want to take them out. It might be the seller has an investment account and they're generating interest on that investment account, or it's the income from other investments that the business engages in, but not operational in nature, and that we're not going to be inheriting when we buy the business. Depreciation, straightforward. Bad debt write-offs. Salary of the wife, we talked about. Now, rent, we need to make a rent adjustment, because in this instance, the business owner owns the building, but we're not going to buy the building from him. Okay, so we need to make, we're actually going to rent it back from him. So we need to make a consideration for that we're going to be paying him rent. Now, here, well, you can see that he's charging $144,000 in rent to himself. He's got the company is in another, the property is in another company. He's charging $144,000 a year. It's not actually accurate market rent. And when we come in, we're going to be paying $480,000 a year. So we've subtracted $480,000 from our profits and added back the $144,000 that's already being paid to accurately reflect the extra odd around $336,000, I think that is, that the business is going to have to be paying in rent that it's not currently paying. Director's salary, we add that back and normalize it. So he's underpaying himself a little bit here. We think because when he leaves, we're going to have to go and find a new superstar to run this business. They might be on comms. We've estimated that the market salary is going to be 1.2 million. Sounds crazy. I know, just the numbers are just an example. So we've taken his out as it is right now and accounted for a new one at market related rents. His motor vehicle, so personal expenses that the owner is running through the business that are not operational in nature, we added the motor vehicle expenses back. A management fee, he had a management fee in the line items, some payments that he was making to another company, again for tax efficiencies, and then finally municipal expenses. And so, you know, we're obviously not going to be paying majority of these municipal expenses because we're not going to own the property. We're still going to pay the electricity and utility bills. And so that's why we've only put, you can see a note here, it's normalized for a third of total utilities. So we took the utilities and divided it by 3. So we've added back a third of the utilities, and we're expecting that we're still going to have to pay 2/3, i.e. electricity and the things that a tenant would pay as opposed to a landlord. And then of course, travel. That's the owner is putting his own travel on the account of the business. That gives us an adjusted EBITDA of 2.6, 1.22, 1.609. Okay. So that's how we get to EBITDA. From there, we want to take an average of the last 3 years, which is 1.8 million. Okay, so there's our magic EBITDA number, and we're going to get to our multiple and applying our multiple to that in just a moment. So now this is where the research comes in. So we know it's a healthcare business. We know roughly what size it is. It's generating about 6.5 million a year in revenue. And so we go over to any old website. I just found this on a Google search. Here you can find healthcare EBITDA valuations and multiples. We go and find what type of business it is. We're going to say it's a medical practice. Okay. And we can see here 5.7 times for 1 to 3 million, 7.5 times to 3 to 5 million, and 8.9 times for 5 to 10 million. So that's our magic multiple. Okay. We come back here. What did we say it was? 8.9 times. We come back here, equals this times 8.9. And the value of the business is right there, $16,273,014. And that's what that business is worth. Okay. Now, are we going to pay that much in reality? No, it depends. We look at this, right? There are a lot of factors that goes into attributing what this number actually is. Now, how much we actually pay really depends on how good we are at negotiating this. Ultimately, what you want to find is a motivated seller. It's someone that needs to get out of the business now, whether it's they're retiring, they had a divorce, whatever it might be. And it's an urgent matter for them to ultimately sell their business to you so that we can crank down this multiple to about 5 times. You don't want to be paying more than 5 or 6 times to buy a medical practice or any of these businesses for that matter, because remember, we want to buy it for an amount where the debt service, the cash flow covers the debt service. So here's where the beauty is. We want to buy the businesses in this range, $1 to $3 million, turn them into a company doing this much so that we can sell them for this multiple. So let's say we come in and we buy 3 businesses at a 4 times multiple. These 3 businesses we're going to buy for $12 million each, which is $36 million in total. Again, don't worry, the bank will give us the money, someone will give us the money. It doesn't have to come out of your pocket. The numbers are big and scary, but you don't have to worry about them. So your total outlay is $36 million on those 3 businesses, and you're doing $9 million in EBITDA. You carry over to this range now. Your 9 times 7 is $56 million, your total valuation, minus your 36, you've just made $20 million in additional value that you can then, realize when you sell the business, or, you can refinance and draw some of that money from the business. Again, a conversation for another video, but that's where the value creation comes from. And that's how you build mega wealth doing this stuff. That's exactly what we're doing here in my local market. Like I said, we already have 3 deals that are being done right now. And, we're hoping to buy 50, 60 of these businesses and then eventually flip it to a large multinational corporation. So there you have it. That's how you value these businesses. A couple of points to note. Firstly, if there is property in the business, generally what we do is we add that property asset value on top of the EBITDA multiple. It really depends. So these may actually, and you have to do your research on where they get the data from. These companies that they take averages from may own a lot of these assets, including their real estate, right? So you have to do more research to better understand. When we're looking at our local multiples here, we apply the multiple and then add the property value on top. And then there are some really creative financial structuring methods so that we can buy those businesses with effectively no money down. I'll show you how to do that in the next video. So there you have it. If you have any questions at all, please do just let me know. I'm happy to answer all of the questions. I read all of the comments, of course, down below, because there's not that many of them yet, but there will be soon. Now, drop a like, drop a comment, subscribe, and make sure you are around for the next video. I'm really looking forward to it.